Hey everyone, welcome back to Corporate Decoder, the place where we unpack the secrets buried in corporate filings and try not to fall asleep doing it. Today we have a report from SPIRE Incorporated, and let me tell you, they've been busy making some big financial moves. So what exactly is SPIRE Incorporated up to? Well, it looks like they've been busy with some financial engineering, a fancy way of saying they've been restructuring their debt and preferred stock. You might see terms like depository shares and perpetual preferred stock and wonder what is going on. Think of it like this, they have different ways of borrowing money and getting capital to run their business. This report is essentially an update on a specific type of borrowing and how it relates to their preferred stock. We're talking about SPIRE Incorporated, a company that has been around and operates in the energy sector. They provide services that are essential to everyday life. When companies like this make changes to their financial structure, it often signals a strategy to become more efficient or to manage their costs better. It is like a homeowner refinancing their mortgage to get a better interest rate. This particular document is a Form 8K, which is like a special announcement filed with the Securities and Exchange Commission, or SEC. It is used to report significant events that shareholders should know about. In this case, the main event is the issuance of new debt and how it ties into paying off some of their existing preferred stock. Now let's get to the good stuff, the money. SPIRE has issued what they call junior subordinated notes worth a whopping $200 million. That is a lot of zeros. These notes are basically a loan that SPIRE has taken out and they have to pay it back with interest. The interest rate here is 6.375% and these notes are due in 2086, which is a very long time from now. Think of it as a super long-term loan. This type of debt is considered junior, meaning if the company ever ran into serious financial trouble, lenders of these notes would get paid back after other more senior debts. Now here is where it gets interesting. SPIRE is using the money from these new notes to redeem or essentially buy back their 5.90% series, a cumulative redeemable perpetual preferred stock. This preferred stock is another way they raise money, but it comes with a fixed dividend payment. By redeeming this preferred stock, they are paying off shareholders who hold it. They're paying off $250 million worth of this preferred stock. So they borrowed $200 million and are using it to pay off $250 million of preferred stock. This might seem like they are short $50 million, but the report also says they are using other funds to cover the redemption. The key takeaway here is they are replacing one form of capital with another, potentially at a better rate or with more flexibility. They are also getting rid of this preferred stock entirely. The company states a clear intention here to use these proceeds, not just for redeeming the preferred stock, but also for other general corporate purposes. This is a common phrase in these filings, and it means they have flexibility to use the remaining funds for whatever they see fit to run the business. It could be for investments in new projects, upgrading infrastructure, or simply to bolster their cash reserves. They've even applied to have these new notes traded on the New York Stock Exchange. This means everyday investors can potentially buy and sell these notes just like they would buy shares of stock. It also signals SPIRE's access to capital markets and their ambition to be a significant player. The fact that trading is expected to begin within 30 days of issuance means this is a fresh financing event. The report also mentions that these notes were registered under the Securities Act of 1933, a regulation that governs how securities are offered and sold in the United States. It means SPIRE has gone through the necessary legal steps to make sure this debt offering is compliant. You'll also see references to legal opinions from firms like Stinson LLP. These are essentially expert endorsements confirming that the notes are validly issued and legally sound. It adds a layer of assurance for investors. Now let's talk about what this all means from a strategic perspective. SPIRE is essentially refinancing a portion of its capital structure. They are moving from preferred stock, which has ongoing dividend payments, to debt, which has interest payments. The new debt has a higher interest rate of 6.375% compared to the 5.90% dividend on the preferred stock. However, debt interest payments are typically tax deductible, which can make them more cost-effective for the company in the long run. By redeeming the preferred stock, they are eliminating that fixed dividend obligation, which can provide more financial flexibility, especially if their earnings fluctuate. This move can be seen as a proactive step to manage their financial obligations and potentially improve their overall cost of capital. It also simplifies their capital structure by removing a class of preferred stock. Looking at the numbers, specifically the decision to issue $200 million in new debt to redeem $250 million of preferred stock suggests they believe this is a financially beneficial swap. While the interest rate on the new debt is higher, the tax advantages of debt and the elimination of the preferred stock dividend could offset this. It is a calculated move to optimize their balance sheet. The fact that they can successfully issue $200 million in new debt and are confident enough to plan for its trading on a major exchange suggests investor confidence in SPIRE Inc. So what is my take on SPIRE's latest financial maneuver? It appears to be a well-considered refinancing strategy aimed at optimizing their capital structure and potentially reducing their long-term financial obligations. By issuing new debt, they are gaining flexibility and possibly tax advantages, while eliminating their preferred stock obligations. The higher interest rate on the new debt is a point to watch, but the tax implications of debt combined with the removal of the preferred stock dividend likely make this a net positive for the company. The risks involved are typical for any debt issuance, including interest rate fluctuations and the company's ability to service its debt. However, given SPIRE's position in the essential energy sector and their ability to access capital markets, it appears they are on a solid path. Alright, that is our breakdown of SPIRE Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for more real-time insights and discussions. Thanks for watching. See you next time.